Hi and welcome to Straight Talk. With the New Zealand dollar hovering at about the 74 cent US level, dairy farmers can quite easily do the maths as to what this is costing them off their payout for this season's milk. This at a time when Fonterra looks likely to be calling upon them for more cash in its capital restructuring program. And then there's the suggestion of a flat tax or a capital gains tax being thrown into the mix. Today I'm joined by Bernard Hickey from interest.co.nz and Ellen Reid, National Business Review's news editor. Well, Bernard, how high can the dollar go?
Well, our readers are saying it could go to 80 US cents. And in fact, when you look at how weak the US dollar is and the problems they're having in the United States with their economy and with the amount of debt they're raising, the amount of money they're printing, you could see conceivably the New Zealand dollar go to parity for $1 within the next couple of years, unless we see the New Zealand economy go into another dive and we see foreign investors lose confidence in the New Zealand dollar. At the moment, they seem to love us. And we heard from Bill English coming back from overseas this week that he doesn't think he'll have any problems selling this $40 billion worth of New Zealand government debt because, unlike the rest of the world, New Zealand and Australia haven't been printing money, so they love our currency. And so that's a real problem for exporters and for farmers, the idea that over the next couple of years we really could see the New Zealand dollar go to $1 US if the US dollar collapses, and that's quite possible at the moment.
Yeah. So we might have a situation where the average New Zealand motorist is blaming dairy farmers for increases in their petrol prices based on the fact that every time Fonterra's global dairy trade auction system records an increase, there's a similar jump in the level of confidence in the New Zealand economy generally.
The rise in soft commodity prices, so dairy, wood, fish, is a factor in the New Zealand dollar rising, but it's only a small factor. We're riding the coattails of the Australian dollar more than anything else, and that's going up because of higher metals prices, iron ore, also coal and gold. But it's actually much more to do with what's happening in the financial markets and the weakness of the US dollar and the weakness of all those currencies where the central banks have been printing money, rather than the rise in the Fonterra payout or the rise in wholesale commodity prices for Fonterra. So I think those people who are in the know will not blame the farmers, and I think the farmers have plenty of reason to jump up and say, hey, we're hurting even more than you are because of this higher currency.
So we've just got to learn to love the high dollar, Ellen.
I think so. There's not much sign of it going down for any reason at the moment. Further to what Bernard said, as the US dollar stays weak, we obviously go higher. That's just the way the money market works. The Australian Central Bank became the first in the world to raise interest rates in the wake of the global economy recovering, fingers crossed, hopefully, last week, which was a little bit sooner than some commentators expected. So that increases the appeal of the Australian dollar, and we ride on the coattails of that. And also, as the global economic recovery continues and picks up pace, there's more risk appetite for investors, and they tend to like our currency, our New Zealand currency then.
And the New Zealand interest rates are already rising at a wholesale level, and the official cash rate, the Reserve Bank, is likely to start increasing it next year sometime, probably earlier in the year rather than later in the year. The Reserve Bank itself says we won't start increasing the official cash rate until late 2010, but the markets are saying early 2010 now, because we're seeing some signs from the New Zealand economy with stronger retail sales this week and other factors showing the economy is picking up a bit sooner than some people had originally predicted, that the pressure will go on interest rates, and that again will put the fire under the New Zealand dollar.
I think there may still be some risks around the interest rate timeline, and I'm not as optimistic as Bernard, or pessimistic depending on which side you're on, that they're going to be raised earlier. There are emerging signs of recovery, but a lot of the data I've been looking at shows that it's opinion and confidence and intentions rather than actions necessarily backed up with increasing spending and hiring people and things like that. So while it's a very positive sign, we're beginning to see talk of a recovery and there's some tentative signs, I don't think we're out of the danger zone yet. And I think we run the risk of not backing up our action. They are words with actions. In which
so
case interest
there
rates
could
are
be the
lower.
risk of a false dawn in terms of people talking about the green shoots of economic recovery. They might not actually burst into
They might.
proper bud.
There's some talk of a W-shaped recovery where obviously the confidence in the economy goes down, it comes up, and then we may go down again before we recover properly. So there's some talk of that.
The issue, though, is that we are seeing some real increase in retail sales, and we're seeing increases in car sales itself. We're also seeing, it's true, Ellen's saying, the increase in business confidence and consumer confidence, but the track record of those flowing through into spending in the economy is very strong. And also, frankly, this is an economy that is a housing market with some bits tacked on, and right now the housing market is getting back to its old glowing self as we head into spring. We saw some figures out this morning showing that house prices are up again in September. With confidence returning to the housing market, that's boosting the economy and putting the pressure on the Reserve Bank to start putting up interest rates if it really wants to avoid our economy becoming unbalanced.
Because certainly there's plenty of anecdotal evidence around in Auckland as regards house sales and people rushing in with early bids and properties not going to auction and so forth.
That's right. It's the big cities where the housing markets are picking up. Again, it's almost a circular thing because there's confidence in the housing market, house prices are picking up. Interestingly, in the regional cities, where the economies there are more dependent, particularly on dairy, which has had a tough year or two, they're not growing so quickly. So this again is another one of those unbalanced recoveries where the big cities, based on the housing markets there, recover before the regional economies, based on something real, actually recover. So there are some dangers there for the Reserve Bank.
Right.
There are, but is that necessarily a bad thing if the big cities recover first? If the figures is believed that show that Auckland contributes 30% of the national economy, wouldn't you want that sort of cornerstone recovering in place? I get what you mean about a balanced economy, but I don't think there's any damage necessarily if the cities lead the way.
Yes, Auckland has been a laggard for the last couple of years, and you'd expect it to rebound before the rest. My concern and the concern of those in the Reserve Bank and Treasury is that what we're seeing is a housing-led recovery, which fails to rebalance the economy towards our export sector and essentially repeats the mistakes of the past where we suck in foreign debt, push up the currency, pump it into batches and properties and more land, and not invest it in our export sector and in businesses who we need to grow to be able to service our huge foreign debts. That's the worry, and I think the Reserve Bank will be looking at this closely. Its only tool is to put up interest rates, and I think that's what they're going to have to do in the next 6 months or so. Well,
investment is certainly on Fonterra's mind at the moment with the formulation of its capital restructuring proposal. What feedback is there coming from farmers about how they like the look of what Fonterra is suggesting?
Some farmers, particularly the big ones who have got some leeway with their bankers, who have plenty of equity in their land, are looking to borrow more money from their banks to top up to the 120% that Fonterra are talking about. So
they're seeing it as a good investment backed by Fonterra's present and projected returns?
Well, that's the thing. The current returns, the evaluated returns, seem to make sense. You get a return of 10 or 11%. But what's going to happen in the future, we'll see. It will depend on the vote in November, and I also think there's some questions to be answered about the trading system that has yet to be set up and won't be voted on until 2010. That will determine how liquid these dry shares will be, how many people are going to be buying and selling them, and I think Fonterra will have to re-look at this limit of 120% of shares, because once you've got the people who've bought and they've topped up to their 120, they won't be able to buy any more. And the whole point of a trading system is to reduce the redemption risk for Fonterra. And if there's not a liquid market in these things, this idea will fail. So I think there's some real questions to be answered yet on the structure of the deal, particularly the third step towards a trading system.
And presumably you want to give farmers who are interested in this form of investment as much flexibility as possible.
Absolutely, and I think it's quite hard on them that they're being asked to consider the first steps in the whole package without knowing, as Bernard said, the mechanics of how the market's going to trade. I think that's going to be the main concern. If you buy these shares, are you able to divest them if you need the cash for something else?
And the issue too is that over time Fonterra will need more capital if it's going to grow. So how far do you go before you start worrying that the dry shares start to overwhelm the interests of the wet shares? And that's always been the worry of farmers.